Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 2 of Understanding Efficiency Ratios, a guide to analyzing business performance. Trends over time. Analyzing ratios over a single period provides a snapshot, but trends over time tell the full story. This approach helps track improvements, spot recurring issues, and anticipate future challenges. Numbers can fluctuate seasonally or during major business changes, so understanding the why behind trends is crucial. Here's how to analyze ratio trends effectively. Create a timeline. Map out ratios over months, quarters, or years. Focus on consistency rather than one-off results. Identify patterns. For example, do you see steady improvement in your accounts receivable turnover ratio? That could indicate better credit policies or stronger customer payments. Spot red flags. A declining asset turnover ratio, for instance, might suggest inefficiencies in resource utilization. Consider external factors. Economic shifts, market trends, or internal decisions like expanding inventory can influence ratios. Ask yourself, are changes operational or market-driven? Tracking trends over time is like watching a movie instead of looking at a single frame. It gives you a deeper understanding of what's working and what's not, allowing you to make smarter decisions for your business moving forward. Together, benchmarking and trend analysis provide a balanced approach to evaluating efficiency ratios. By combining these perspectives, you'll build a clearer picture of how efficiently your company operates, enabling better strategies for growth and improvement. Limitations of efficiency ratios. While efficiency ratios are great tools for evaluating business performance, it's important to understand their limitations. Without proper context or consideration for external factors, these numbers can mislead or oversimplify complex situations. This section dives into 2 key challenges you may encounter when interpreting efficiency ratios: the importance of context and the influence of external factors. Contextual understanding. Explain why context is essential when interpreting efficiency ratios. Efficiency ratios might seem straightforward, but without context, their meaning can easily get lost. Think of these ratios as puzzle pieces. They only make sense when you see the bigger picture. Comparing an inventory turnover ratio between 2 companies, for example, is meaningless without understanding their industries. A retail store with seasonal demand operates very differently from a manufacturing plant with steady production cycles. Here's why context is essential. Industry differences. Each industry has its own benchmarks. A good ratio in one sector could be poor in another. Company size. Larger firms often have different efficiency metrics due to economies of scale, while smaller companies may face resource limitations. Business model variations. A subscription-based business won't have the same receivables dynamics as a pay-per-product model. You can't interpret ratios in isolation. Context provides the framework to make meaningful comparisons and identify actionable insights. Without it, you risk drawing inaccurate conclusions. Impact of external factors. Discuss how external factors can skew efficiency ratios and lead to misinterpretation. External factors can significantly alter a company's efficiency ratios, giving a distorted view of performance. These influences often lie outside a company's control, yet they play a huge role in shaping the numbers. Consider these common external factors. Economic conditions. During a recession, a drop in sales or slower collections might drive down efficiency ratios, even if the company itself is performing as well as possible. Market trends. Shifts in consumer behavior or supply chain disruptions can impact inventory and asset turnover, making it hard to analyze true efficiency. Seasonality. Some businesses face predictable fluctuations based on seasons or holidays, which can skew short-term ratios. For example, a retail store might see a sharp increase in accounts receivable during the holiday season, despite otherwise strong collections. Regulatory changes. New laws or trade policies may compel businesses to adjust operations, temporarily disrupting efficiency ratios. Numbers alone never tell the whole story. Imagine watching only the final lap of a race. You'd miss everything that led up to the finish line. Similarly, ignoring external factors can make efficiency ratios look too simple or even misleading. By keeping context and external influences in mind, you'll get a more accurate understanding of what these ratios truly represent. This deeper insight can prevent costly misinterpretations and guide better decision-making. Real-world applications of efficiency ratios. Efficiency ratios aren't just numbers on a spreadsheet, they're tools that businesses, investors, and stakeholders use to make critical decisions. Whether it's pinpointing areas for improvement or evaluating a company's financial health, these ratios offer practical value in real-world scenarios. Let's explore how they're applied, from the strategies of successful companies to the insights investors rely on. Case studies of successful companies. Successful companies don't just track efficiency ratios, they use them as a guide to streamline operations and boost results. Here are a few examples of how well-known brands have applied these ratios to their advantage. Amazon, inventory management. Amazon's high inventory turnover ratio is a testament to its efficient supply chain. The company has mastered just-in-time inventory practices, ensuring products are stocked and shipped quickly. By monitoring this ratio closely, Amazon minimizes storage costs while meeting customer demands. Toyota, asset utilization. Toyota's lean manufacturing philosophy revolves around efficiency, with the asset turnover ratio playing a key role. By optimizing how assets like production equipment are utilized, Toyota consistently ranks among the most profitable auto manufacturers. Apple, accounts payable strategy. Apple leverages its strong accounts payable turnover ratio to maintain favorable terms with suppliers. By carefully timing payments, the company balances cash flow without jeopardizing relationships with key partners. These businesses show how efficiency ratios can lead to sharper strategies and competitive advantages. For them, these aren't abstract calculations, they're actionable insights. Importance for investors and stakeholders. Efficiency ratios also play a big role in guiding investment decisions and evaluating long-term business potential. Here's why these metrics matter so much to investors and stakeholders. Quick performance assessments. Investors often use efficiency ratios to make snap judgments on a company's operational strength. For example, a high accounts receivable turnover ratio signals reliable cash flow, essential for meeting obligations. Benchmarking the competition. Efficiency ratios help stakeholders compare a business to its peers. If company A's asset turnover ratio is significantly higher than company B's, it could indicate better productivity or smarter resource use. Identifying risks and weaknesses. Low efficiency ratios can signal trouble. A sluggish inventory turnover ratio, for instance, might point to overstocked inventory or weak sales. Investors use this information to weigh risks before committing capital. Evaluating management effectiveness. Investors often view these ratios as a reflection of leadership ability. Efficient management of assets and liabilities doesn't happen by accident, it's a sign of strong decision-making at the top. For investors and stakeholders, efficiency ratios are more than data points. They're windows into how well a company operates and whether it's positioned for growth. These ratios simplify complex operations into metrics that are easy to compare, track, and analyze. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.